Hi everyone, I hope you're all doing fine. So today we'll continue chapter 25. We reached part 2. So in this PowerPoint we're going to talk about how banks operate, how banks create money, the modern banking system, and the required reserve ratio. So let's start. So first of all, let's take a historical look on how banks used to operate in the 15th and 16th centuries. So back then, gold was used as money, and people used to deposit their gold with the goldsmiths. In exchange for that, the goldsmiths provided the depositors with receipts that are backed with gold. Okay, so back then, people who had gold, they used to go to their goldsmiths. They used to deposit their gold there, and the goldsmiths would give them receipts. Okay, and whenever the people wanted to get their gold back, they used to go back and give the receipt, and the goldsmiths will give them back their gold. Okay, so the goldsmiths started to issue more receipts than the actual gold account that they have. Okay, so they had a lot of gold from people, so they started to give loans to other people from the gold that they have from people. Okay, because they thought that it's almost impossible that all customers will come and ask for the gold at the same time. Okay, but during recessions or when customers uh, started to have doubts about the goldsmiths, something called bank run used to happen, which is when the depositors go to the goldsmiths at the same time to take their gold back. Okay, so whenever there was an economic problem or trust problem, the depositors would go back to the goldsmith and ask for withdrawing their gold. Okay, and in this case, if the goldsmith did not have enough liquidity, like if they did not have enough gold to give it back to the customers, then they will face bankruptcy, meaning that they will fail in giving the customers their gold and at the same time would have to pay from their personal account, for example. Okay, now moving to nowadays. Nowadays, banks operate by keeping a fraction of customers' deposits in the form of reserves. Okay, so nowadays banks should always keep a fraction or a part from the customer's deposits aside. They cannot give loans from it or anything. They should keep it apart, and they use the majority of customers' deposits to issue loans and buy securities or bonds. So the customer deposit is divided into two parts. The first part is the reserves. Banks keep it as reserves, and the second part is for issuing loans and making profits and buying bonds. Okay, so also in contrast to goldsmiths, banks nowadays have to meet the legal reserve requirement, which is a minimum fraction of deposit that has to be kept in the form of reserves. Okay, so goldsmiths did not have a legal requirement that they should follow, but now banks have a legal requirement, which is as we said before, keeping a minimum fraction of deposit aside in the form of reserves. Okay, and this minimum fraction of deposits is called the required reserve ratio. And if you want to calculate it, the required reserve ratio is equal to the required reserve over deposits times 100. Okay, now let's talk about the modern banking system. So we have this equation, I think you're familiar with it, which is assets minus liabilities is equal to net worth, the same as assets equal liabilities plus net worth. Okay, so let's talk about assets, liabilities, and net worth of a bank. So the main assets for a bank would be deposits with the central bank, the loans, and securities. So those are the main assets that any bank have. They have the deposits. We can also call this the reserves. We have the loans that they issue for the customers, and we have the bonds. Now moving to liabilities, the main liability for a bank would be the customer's deposits. So the customer's deposits are considered to be assets for the customers because it's their own money. but it is considered to be a liability for a bank because they are obliged to pay them back. So the bank should pay the customers back their deposits. So that's why the customers' deposits are considered to be a liability or an obligation for the bank. And net worth, it of course represents the value of the bank to its owners or stockholders. Okay, now let's talk about the two types of banks. So we have two types. The first type is the commercial or regular banks, and the second type is central bank. So let's start with the commercial banks. It is the financial, they are actually the financial intermediary between savers and deposits, or we can say also borrowers and lenders. So a commercial banks are the normal banks that we go to when we want to deposit our money or if we want to take loans. So we go to the commercial bank. So it is the intermediary between the savers and the depositors. Okay, and moving to the central bank, it is the bank of all commercial banks. Its function is to control the money supply in the economy. So the central bank, it is like responsible of all the commercial banks, and that's where the commercial banks put their reserves. They put reserves in the central bank, and the function of the central bank mainly is to control the money supply in the economy. And we spoke in the previous chapter what are the functions of the Fed. The Fed is the central bank of the U.S. So you can check chapter 24 to see more functions of the central bank. Okay, so as we said, in the US, the name of the central bank is the Federal Reserve Bank, and in Lebanon, it is called Bank de Liban. I hope I said that right. Okay, now let's talk about the required reserve ratio. As we said previously, that legally, banks are required to keep a minimum fraction of the deposits in the form of reserves, and this fraction is called the required reserve ratio. And if you want to calculate it, it is the required reserve over deposits times 100. And if you want to calculate the required reserve, it is the required reserve ratio times deposits. Okay, so now we have a quick example. So if deposits are equal to $100,000 and required reserve ratio is equal to 10%, then we can conclude that the required reserve is 10% times $100,000 equal to $10,000. So the $10,000 is the required reserve, meaning that it is the amount of money that the bank should put as reserve. Okay. Now moving to how banks create money. So first of all, we have this equation. It's reserves equal to required reserves plus excess reserves. So reserves is the amount of money that banks get. Required reserve is the required fraction that banks should put aside to meet the legal requirement, and plus excess reserves. So excess reserves are what's left of the reserves after substituting from it the required reserve that we should put aside. So the bank uses its excess reserve in order to make loans. Okay, so reserves are divided into two parts: the required reserves and the required reserves that should be put aside, plus the excess reserve that the bank can use in order to give loans or to buy bonds or to make profits. Okay, so in this chapter, we are assuming always that the required reserve ratio is equal to 20% and that banks do not keep they do not keep excess reserve. So we are assuming that reserves is equal to required reserves, okay, to make things simple. So suppose that we have an economy with one bank only and a customer comes in with $100 cash deposit. Okay, so technically, if the customer have 10 if the customer comes with a $100, then according to our assumptions 20% of it should go to the required reserve, and the other part should go to the excess reserve to issue bonds or to issue loans and buy bonds. So technically $20 will go to reserves and $80 will go to loans or buying bonds. So this was part 2 of chapter 25. We still have 3 parts left. It is a long chapter. So keep updated for the other parts and thank you for listening.